Am I audible, guys? Type in the chat section if I am, please. Okay, guys, so we'll start now. Welcome to the session. My name is Ritik Ramaya, and I've been trading since 2 years now. I've been trading Forex since 2 years, and I started small and by gaining experience through the market, and I progressed my way further into the Forex market. So today we'll be going through what is the basics. I'll be teaching you some basic concepts about Forex trading. I've done quite a few sessions with dream merchants and all over the internet, and today I've been invited by dream merchants to give a talk on what is a Forex trading. So basically, Forex trading is about trading currencies, how different currencies are traded on the international market. So basically, let's say you are in America and you want to go to, let's say, London. So there's a two different currencies, which is the dollar, and in London they use pound. So when you go to from America to London, you basically change dollars to pounds. So when you change dollars to pounds, you get pounds. Now let's say you went with $100 into uh, London, and let's say the rate was 1:2. So you for $100, each $100 you'd get 200 pounds. Okay. Now let's assume you didn't spend the money in London and you came back again to America, and the rate became 1 to 3. Okay. So for the 200 pounds, you eventually got 60 uh, $60, 60 $67, 66 $66, because 200 divided by 3. So this change, 1 to 2 and 1 to 3, this is the change in is what we see in the forex market, basically profit. So this is how forex trading is done. It is basically, the official definition is, the market national currencies are traded, and the forex market is the largest, most liquid market in the world, where trillions of dollars are changing hands every day. Changing hands every day, that means that there is some fluctuation which goes on. Also, there is no centralized location. Rather, the forex market is the brokers, institution, and individual traders. Now, if you assume, am I audible, guys? Hello? Hello, am I audible now? Can someone help me in the comment section? In the hello? Okay, so I'll continue again. Uh, Poonam, you said you missed the amount when I divided by 3. Please repeat. Okay. So basically, let's say you are in America and you go to London. The price for dollar to pound is 1 ratio 2. So for each $1, you will get 2 pounds. Okay. Now you have $100 with you. Okay. If you have $100 with you, when you go to London, you will get 200 pounds. Okay. If you get 200 pounds, assume now you did not spend the money in London, you have with you. Okay. Now if you have 200 pounds with you and you come back to America, and now the ratio of dollar to pound is 1 ratio 3. So how many dollars will you be getting? Are you getting my point? So you will be getting $66. So for each $66 you change, you will be getting 200 pounds because the price of pounds has decreased. So if this is the fluctuation we see, so basically 1 to 2 and 1 to 3, this is the fluctuation we always see in the forex market. So to give an official and clear definition is forex is a marketplace where various national currencies are traded. Also, it is the most largest and the most liquid market in the world, with trillions of dollars changing each day. Also, there is no centralized location. Rather than the forex market is an electronic network of banks, brokers, institutions, and individual traders. Now, have you imagined when you keep money in the bank as a fixed deposit? Interest. What do the banks do with your money? Do you know? Actually, the banks, they put the money in the forex market. They trade different rate profits and for capital. Not only forex, they have also other schemes, but one of the main schemes of their income, of banks' income, is the forex market. Now, if you can see, there are some currencies on my screen right now. If you can see, can you see my screen where there are different currencies, bid, ask, high and low? So these are some charts on my screen right now. You can see Euro USD, USD JPY, GBP USD, USD CHF, Euro GBP, Euro JPY, and so on. Now we have a bid and ask price. What is a bid price and what is a ask price? A ask price is basically you are buying. The different word for ask is a buy, and the different word for a bid is sell. So if you want to buy Euro USD right now, you will be buying at 1.3350 and the bid price is 1.3348, which is the selling price. Now to go on the simple definitions in the forex market, you can see there are some simple definitions in the forex market. The first definition is called a pip. Now, what is a pip? A pip is basically a change, a small change in the current market price and the change. So basically, let's say if you buy something for $5 and you sell it for $7, the change is 2. Now, if the change is 2, what we get is the pips are 2. Now in forex we have different. Hello.
Okay, I get a question in the comment in the live chat section. What is the minimum amount we can invest? I personally started with $10, so I think $10 is fine for an initial investment. And Rakshit Magon, you asked, what if they lose our money? Now, why do banks guarantee? Because they know they will be able to generate that kind of income. Because in the forex market we have losses, but one of the ways of the bank is the forex. The other ways are they also invest into the stock market, they also give out loans from which they will be earning interest. So there are different ways in which the government in which the banks secure your money for you, so there is not an issue. Maukhik Mishra, is there some eligibility criteria for trading? Okay, so the basically eligibility criteria is you must be having a identity of your own, I mean the ID card, some kind of proof that you exist, some kind of ID card. And the other thing you need is a bank statement. If you have a bank account, then you are eligible to trade, and of course some initial capital. That is the only thing which is required while trading. So to continue again, a pip is basically a small change, a small change in the market price and the last final price. Now what happens is that if the euro USD is currently trading at 1.1558 and it rises to 1.1562, the rise would equal to a change of 4 pips. Now how do we get this change when they are decimal places? So what we do is we calculate the last 3 or 4 digits and minus them by the initial price. So here we take 562 minus 558. So the last 3 or 4 digits are the ones which we minus. So 562 minus 558 equals to 4 pips. However, some currency pairs have their pips located at the second decimal place, mostly the Japanese yen pairs. Now let's take an example of USD JPY. it currently trades at 110.25 and falls to 110.10. That would be equal to a change of 15 pips, because 25 minus 10 equals to 15. So here we get 15 pips. Now we go to the official definition. A pip is a short from percentage in point and represents the smallest increment that an exchange rate can move up or down. Usually 1 pip equals to the fourth decimal of the most currency pairs. Is pips understood, guys? Can I get some yes or no in the live chat, please? The other definition, the other terminology we need to know is basically a lot size. So lot size is basically the amount of money you are willing to bet on a particular pip change. So let's say if you bet a lot size of 1, then if there is a pip difference of 1, then you would get $1 for each pip. If the lot size is 0.1, the pip difference is, let's say, 10, then you will be getting 0.1 times $10. So eventually the how you calculate your profit is basically lot size times pips. So if you keep a lot size of 1 and your pip difference is, let's say, 10, then you would be getting $10. So pip times lot size is equal to profits. Now let's say we have these charts here. Okay, we have the currency pair is euro USD. The exchange rate, let's take an example of $1 is equal to 1.29. That's called an exchange rate. The pips, as I said, is the buying price minus the selling price. So the price you are holding it and the price you are ending it. The equity is basically a balance in your account. What execution means is whether you are placing a buy order or sell order. That means you are executing an order. The lot size is basically how much you want to bet. Now what we calculate, let's take an example of buying price which is 1.2178 and the selling price which is 1.2188. okay, my lot size is 10. So I said profit is equal to pip times lot. Buying price minus selling price, we know it's 188 minus 178, which is a difference of 10. When we have a difference of 10 and the lot size of 10, we get 10 times 10, which is equal to $100. I repeat again, we get selling price minus buying price is 10 pips, which is 188 minus 178. We check the last 3 or 4 digits. Lot size is 10, so we'll get 10 times 10, which is 100. Let's take a different example. Now we have a buying price of 1.8384 and we have the selling price is 1.8389. We have the lot size which is 1.8389. Now here we have a difference of how many pips? 5 pips, and the lot size is 100. So as I said, profit or loss is calculated by pip times lot size. Now we have a pip which is 5 and the lot size which is 100. So we get $500 because 5 times 100 is equal to 500. Am I clear up to here right now? How you calculate your profits and loss? Now I get a question. Do you prefer apps like Upstocks or Zerodha? So there's a difference between these apps. Upstocks is basically used for the Indian stock market as well as Zerodha. These are the Indian stock brokers. These are not Forex stock brokers. Now to know more about these brokers, I will be covering up in my session right now, but after some 15 or 20 minutes. So you will be getting to know what's the difference between these different brokers. If you have any questions up to right now, you can ask them in the live chat section. I will be also giving away some prizes at the end if you are interactive with me in the live chat session. The question I get right now is Forex legal in India? Yes, Forex is totally legal in India. There are no restrictions in terms of trading Forex in India. Now we'll go on to what are the tips for a good trader. What the other thing is, you always need to focus on a single currency pair rather than focusing on uh, too many pairs. So what happens is that we need to focus on a single currency pair in order to expand and better our skills and knowledge. So if we focus on a single pair, we will be able to perfect that pair, know the do's and don'ts of their pair in order to stabilize our trading concepts. The other thing is we need to control our emotions. Now, emotions play a very big role when coming to trading forex. Now, some people, if they lose, they would want to trade more in order to recover that capital. So let's say today you took a trade of and lost $5. In order to recover those $5, you will be trading $10. Now if you lose those $10, you are at negative 15. In order to recover those negative 15, you will be placing a higher lot size, or you will be taking a higher risk in order to recover that capital. Now that is very wrong in terms of trading. You always need to look how the market is rather than following your emotions. You need to analyze, you need to give a good analysis and then take a decision on what will happen to the market. The other thing is you need to take notes. Notes are a really important thing while trading. If you don't take notes, you don't study your success, you don't study your failures, then you will not be able to progress in the forex market. And the last and foremost thing is not to give up. If you give up, then there is no point of starting a particular thing. You always need to not give up and practice, because practice determines the key. You start small and grow big. Now I've got a question, that what is the difference between expert option and forex? Okay, what expert option does is basically binary. Expert option is one of the biggest scams, like IQ option, like binary, like binomo. You will not be able to win because the broker manipulates the market, they manipulate the prices. In my session today, I'll be also talking about how these brokers scam you and how to know if brokers are scam or not. As well as I'll be providing you with a link, a particular link which will be able to tell you if a broker is scam or not, with the list of brokers that are scam. Am I so clear till right now? Now we'll go to the another part, which is showing what is the difference between forex and stocks? Many of you have the doubts what is the difference between forex and the stock market. Now, the first difference is forex has a very large volume because it is a worldwide market. The stock market, it has a less volume. As you can see, the forex market is 5 trillion per day and the stock market is 200 billion per day. The second difference is the forex market is highly liquidable. It moves a lot. It fluctuates too much, while the stock market does not fluctuate a lot, apart from the days in which there is some news going to come. The forex market is a 24 hours market. The stock market is an 8-hour market. So let's say you take an example of a Bombay Stock Exchange. The Bombay Stock Exchange opens in the morning at 9 and closes in the afternoon at 3 or 4 p.m. So there comes the limitation. On the stock market, there are high commissions taken up by the broker, while in the forex market, there's very little or no commissions at all taken by by the broker. The forex market, on the other hand, has a narrow focus. The stock market has a wide focus. Now, what do you mean by a narrow focus and a wide focus? On the stock market, you have to monitor different companies because one company is somehow affected by the other, and this always happens because let's take an example of, you say, agriculture. Now agriculture goes hand in hand with the hardware because in agriculture people use hardware products in order to cultivate, harvest their crops, while in the forex market you concentrate narrow because one country depends on the other. There are no many countries depending on too many countries, while in the stock market there's too much of dependency. So these are the differences between the forex and the stock market. Now, I get a question, if it is highly fluctuable, then why should we invest? I mean, fluctuating in a positive way. Now, in this fluctuation, we can make a profit. In the stock market, usually what happens is that fluctuation is very low, so the pip difference is very small. Now if the pip difference is very small, as you can think that the profit is equal to pip times lot size. Now if my pip difference is low, pip difference is directly proportional to the profit, so automatically when the pip difference is low, the profit becomes low. If the pip difference is high, which the case is the forex market, the pip difference is really high and there is a high fluctuation, that means pip difference is high, then pip is directly proportional to the profit. That means if the pip difference is high, then I will be getting more profit. So there is a chance for me to excel more in the forex market rather than the stock market. Am I clear, Poonam? I get a question from Aditya. What are brokers and why is it necessary to have a broker? Now, that's a very good question. Now, the thing is, what are the brokers? A broker is basically, now let me start with the example. If you want to trade something, you will either go to the bank or to a exchange, where they exchange currencies to the branch, and the third way is to the broker. Now, to exchange currencies, you cannot directly go into the market, you cannot directly be connected to the market, because to be connected to the market there are some specific regulations. Now, you are not regulated to do so, but the broker is regulated to do so. Now, the broker is basically a middleman which connects you to the international market. Now, if he connects you to the international market, he is basically a middleman which connects you. So, you can tell him what to do. You want to buy, you want to sell the currency, you want to not buy the currency, you want to invest your money here, you want to invest your money there. He is basically following your commands. Now, why don't we use banks? Because we know that the forex market fluctuates every single minute, every single hour. You cannot keep on going to the bank every single minute and every single hour and getting your currencies exchanged. Also, same with the bureau de change, the foreign exchange shops. You cannot go each and every single time there and keep getting your money exchanged. That's practically not possible. So what we do is that we just go directly to the broker, which is the app in our phone, and get our currencies exchanged there. So this is why we do the broker. Now I'll be going on my next topic, which is investing versus trading. Can someone tell me what is the difference between investing versus trading? Can I get some answers in the live chat session, please? Okay, those are very impressive answers given by all of you. So, the first definition is between investing means keeping your money into a particular item for a long time. On the other hand, trading is a day to day thing. Trading is basically short term. So, The overall definition is that you keep a short term and a long term. Long term versus short term. So let's see the first, which is called the period. Trading is a method of holding stocks for a short period of time. It could be for a week or more often a day. Traders hold stocks till short term high performance, whereas investing is an approach that works on buy and hold principle. Investors invest their money for some years, decades, or even longer period. Short term market fluctuations are insignificant in the long running investing approach. So, here they tell us investing is only for the purpose that the market will go up, while trading, even if the market falls, you will be able to make a profit. On the other hand, we have something known as a capital growth. Traders look at the price movement of stocks in the market. If the price goes higher, they may sell the stocks to make a profit. Simply, trading is a skill of timing the market, whereas investing is an art of creating wealth by compound interest and dividend over the years by holding quality stocks in the market. So, basically, capital growth. Now, investors only look for building different wealth, while traders look for price fluctuations and trade them. So, these are the two differences. The other difference is risk. Now, which one has more risk, investing or trading? Can you guys tell me in the comment section, please? So, do you know why? Which one has more risk? Why? Trading has more risk. Correct. But which one is more profitable? That is the question. Can you guys tell me in the live chat session? And tell me the reason why that investing or trading has more profit. Which one and why? So, the risk. Let's talk about risk. Of course, trading has more risk, but investing is not the less either, because in investing you need to know what you are investing in, you need to study, while in trading you need to study for a short time, but in investing your money is going to go on for years and so on. So you need to take a very clever decision on what you are about to do. Now what happens is that undoubtedly both trading and investing imply risk on your capital. However, trading comparatively involves a higher risk and higher potential returns, as the price might go high or low in a short while. Since investing is an art, it takes a while to develop. So, to become an investor, you need to become a trader first. It involves comparatively lower risk and lower returns in a short run. I repeat, in a short run, but might deliver higher returns in a long term. Daily market cycles do not affect much on quality stock investments over a long time. So, here we learn that stocks is about investing, Forex is about trading. So, if you guys are trading stocks, then you are generating a very low returns. But if you are investing in stocks, that's when you're making the real deals. The other difference is art versus skill. Let's learn it this way. Trading is a one-day cricket match, while investing is a test match. You would watch skillful players in the team who are expected to strike fours and sixes to score higher in a one-day match, whereas the art of game is seen in the test match. Simply, traders are skilled, technical individuals who time the market, learn market trends to hit higher profits in the stipulated time. It is related to psychology of the market. Investors, on the other hand, analyze, as I said, they analyze what they want to invest in. Investing also includes learning business fundamentals and commitment to stay invested for a longer term. It is related to the philosophy that runs the business. Now, what are some of the mistakes which traders make? Can I get some inputs in the live chat session? What is are some of the mistakes? Can someone mention 2 or 3 mistakes what traders make? Yes. Basically, the first mistake is no trading plan. If you don't have a trading plan, you will not succeed. You need to have a plan on what you are going to do, how you are going to trade, what you are going to trade, what is your expected profit, how much you are going to trade with, how much money. So, traders without a trading plan tend to be haphazard in their approach because there is no consistency in strategy. Trading strategy have predefined guidelines and approaches to every trade. This prevents traders from making irrational decisions due to adverse movements. Devoting to a trading strategy is key. Devote yourself to the particular strategy because veering away may lead to traders plunging themselves into uncharted territory with regards to trading style. This eventually results in trading mistakes due to unfamiliarly. Trading strategies should be tested on a demo account. So, before putting your money in Forex, there's always a trading account which is called a demo account, which lets you practice with virtual money. If you have virtual money, you can practice your strategy there. Once traders are comfortable and understand the strategy, this can be translated to a live account. So once you are profitable on a demo account, then you can shift to a live account. The mistake number 2 is over leveraging. Over leveraging is basically you trade a higher lot size not knowing what is going to happen to your account. Your account blows at the end if you don't have the sufficient balance to sustain those losses. So you should never over leverage your account. Always maintain how much lot size you are going to put, because lot size is not only proportional to profit but it is also proportional to loss. If you have a higher lot size and make a loss, the loss is huge. Same with profit, the profit is also high but loss is even higher. So we should always be careful on what we are doing. Mistake number 3, lack of time horizon. What is this? Time investment works hand in hand with the strategy being implemented. If trading approach aligns itself to varying time horizon, therefore understanding the strategy will lead to gauging the estimated time frame used per trade. For example, a scalper will target shorter time frames whilst position traders favor long term time frames. Now, what is a scalper and what is a position trader? A scalper is basically targets small profits. If $1 or $2 profit, he will take the profits. But a position time traders, that means he will hold the trade on for 1 hour, 2 hours, 5 hours, 1 day, or let's say 1 week. And scalper holds for 5 minutes, 10 minutes, 20 minutes and closes the trade. So basically the short time trader versus a long time trader. The another thing we have is poor risk to reward ratio. We don't know what a risk to reward ratio is. So what we tend to do is we see normally what is our risk to reward ratio. Now let's say a chart below shows a long euro USD trade with 1 to 2 risk to reward ratio. The trade was opened at a level of 1.12698 and a stop loss of 1.12598. An effective indicator to help identify stop and limit levels in a forex is the average 2 range, which uses market volatility to base entry and exit point. Having a ratio in mind helps to manage expectations of traders. Now what this basically is that when you are trading, you have a point where you are not able to sustain particular losses. Now to identify that point is called risk to reward ratio. How much you will be risking in order to get a profit, because at a certain point of profit you will be able to gain, to stop the trade. Now when to stop the trade is what a good trader must know, and that is called risk to reward ratio. So when to stop the trade and when not to stop the trade is what makes a good trader. And the last mistake is emotion based trading. So emotional trading often refers to unsuccessful trading, as I explained before how emotions affect our trading. The other thing is selecting an unsuitable broker. There are some brokers like expert option which manipulate the market, as I said. So you must be careful in order when selecting a broker, but I'll explain on how to select a broker. Now here I'm gonna show you the best brokers in the forex industry. So these brokers are considered to be very trustable and have very low spreads overall. So here we go. The first broker is called FBS. This broker has three types of accounts: standard, cent, and micro. I often advise people to go for a standard account because in a cent account it is very difficult to make a profit. Micro account has high spreads, which is commissions of the broker. So I advise everyone to go for standard account. The withdrawals in these brokers take 5 to 6 days through bank and 15 minutes through Skrill. Skrill is basically an online wallet. The other thing is the spreads are quite low for currency pairs. It also has an easy user interface. It works with a MetaTrader 4 as well, and the leverage is reasonable. The other one is XM. This one has very good reviews, as well as it takes withdrawal 5 to 4 days in bank and 15 minutes through Skrill. It works with all platforms, easy. The spreads are quite low, which is the commission taken by the broker. The other one is Hot Forex. Hot Forex is basically one of the most reputable brokers. I am doing a giveaway currently of $150, which you can see my Instagram page for the giveaway details. And this broker has quite low spreads as well and works really well. If you guys are interested in knowing more about the brokers, you guys can subscribe to my YouTube channel anyways. Now we will go to the scam brokers. How brokers can scam one of you. The first is withdrawals. When you make a profit, the broker does not let you withdraw the money. This is one of the biggest things by brokers. They do not let you withdraw your money. The other thing is referrals. A broker always tells you that you must refer a certain number of people in order to withdraw your money. Also, it has higher minimum withdrawals. What does that mean? That means that the broker tells you you must be willing to, you must be having a higher minimum withdrawal. So basically, some brokers can allow you to withdraw $10, but some brokers don't allow you to withdraw $10. They tell you you must be withdrawing $100 or $500 or higher withdrawal. The other thing is that too much of high fees. They cut a lot of service charge when withdrawing. Now this is not good at all, because if the service charge is high, then you are basically earning for the broker, which is not a good thing. The other one is it is unregulated by the FSCA. Now FSCA is basically a body which regulates each and every forex broker in the industry. If these brokers are not regulated, then you don't have to go with those brokers. The other thing is it is the broker people call you, they call you and convince you to join them, or you see some advertisements somewhere and they tell you this is easy profits, this and that. With one button you get $10, $20 profit. So this is very wrong. The other one is the pyramid scheme. Now this is one of the biggest scams which is used by the brokers. They tell you in order to withdraw your money, you must be having 2 or 3 people registered under you. You send them your link and register under you. You'll get benefits. You'll get $100 per each client you bring and stuff like that. So that's all a scam. There are some brokers like Globex 360, they never pay big withdrawals. My friend was scammed $20,000. It's a very scam broker. The other one is the IQ option. Most of you know about this broker because there's a lot of advertisements shown about this broker. um, Lots of advertisements, but they're all false. And yes, they never let you in because everything is controlled by them. And basically what they do is kind of they manipulate the market so they don't let you win, and they trade against you. The other one is uh, these are the two brokers, but if you need this link, then it's there in my YouTube description, in which I have posted a video about scam brokers, or how to know if a broker is a scam or not, in which you can visit, and you can get this link in the description there, and you can search your brokers if you have or not, and at that point you can know if your broker is scam or not. uh, this is basically more about myself, and if you need to learn more, I always have YouTube videos which is helpful for you, where I explain some analysis on how to take trades and how not to take trades. So now if you guys have any questions, I can answer them in the live chat session, so you guys can ask me now. How long does it take to become a successful trader? To become a successful trader, uh, it can take about a year or a year and a half, because to understand the market very well, you need some time. And if you invest time, then it can even take less time if you are very consistent with your strategy and your trades. The other question is, brokerage is cut on total profit, or does the number of trades done also matters? Brokerage is cut on total profit and not on number of trades done, because the brokerage is consistent whether you trade five trades or 10 trades. The brokerage is consistent. There's just one charge. How does the broker earn from you? Okay, how does one broker earn from us? Now, the broker earns from you while charges. There is something known as a spread. Now, when I talk about spreads here, you can see on I have written in the hot forex part, the spreads are quite low for Nasdaq and gold, but a bit high in currency pairs. So depends on what you want to trade. Spreads is basically the how much the broker charges his commission, but usually it's around 0.5 to $1 is what a broker takes as a commission. So that's how a broker earns from you. If they manipulate the market, then however we invest, we will be uncertain about money. Poonam, remember that the broker do not manipulate. There are some brokers like IQ option, expert option. The scam brokers are the brokers which manipulate the market. In investing, there is nothing like manipulating the market. In trading, there is manipulating the market by the scam brokers, not by the truthful and trustworthy brokers. Like Hot Forex, XM, FBS, they do not manipulate the market. It's purely based on what you trade. The other question is, should we trade a single currency or more than one currency? I suggest you always must be starting with a single currency, because if you focus on many pairs, then there is no point, because you will be losing your focus. Be a master of one, then a jack of none. Don't be a jack of all, be a master of one. So always take a single currency and then you need to keep trading. So I'll still wait for 2 more minutes for any further questions, and then we can end the session. The market does not manipulate, the broker manipulates the prices. Now let's say if the broker has a price given of uh, let's say a broker says the price is 5, the market original price is 4, but the broker tells you the price is 5, so the broker manipulates the price. But in the other brokers, the truthful brokers, it's not that, and everyone is not affected. If you invest with, if you trade with a different broker, then why will I be affected if I'm trading with a truthful broker? Because the broker is connected to the market, the broker is not the market itself. So the market has a particular price. Now if the broker is not giving the particular price, then the people who are trading with that particular broker will be affected, not everyone. What do I most trade on? I mostly trade on gold, and I trade on Nasdaq, which are the most profitable items on the forex market. eToro trading app says that they take no option, no commission. Is it a scam? Now eToro trading app, I don't know about eToro, I have heard about it, but with my website, which is this one, brokerdispute.com, you can go and search your broker there, and you can check out if eToro is a scam or not. They'll just tell you directly. Will your forex trade differ according to the volume? No, it won't be different according to the volume, because volume is basically not related to how forex is traded, because volume is how many people are trading in the market. But if you are buying, then it does not affect whether you are buying or selling, because how many people are buying, that's the volume, it will not affect. I was thinking like how Harshad Mehta controlled the market. Okay, Harshad Mehta was pumping the market up, because if he puts in the money, then he is basically increasing the market price. He is not manipulating the market. He is not kind of like, he is not setting the price of what item is there and what item is not there. Basically he is just boosting the stock's price, he is not setting the stock's price. There is a difference between the boosting the price and changing the price. So there's a difference. If I tell you a pencil is sold for 5 rupees, now if the demand is high, then people will obviously sell it for 6 or 7 $7. But Harshad Mehta, what he does, he buys many pencils, so he creates a demand, so he increases uh, the market price. He does not set the market price. The market price is set by the owner of the shop, the pencil owner. There is no link in the description. The link is in my description of the another video in my channel called how to know if a forex broker is scam or not. You can get the link there in the description. How to know if the forex broker is scam or not. There is a video called that. How much time should one give for trading in a day? You can give about 1 to 2 hours. However, I give 15 to 20 minutes only, because I just trade news and not I don't analyze the market a lot, because I just trade news. I trade based on news. So this is how I trade. Any more questions, guys?